On a day where we remember our fallen heroes, especially those who ran up the stairwell, so to speak, on that fateful day 19 years ago, we remember their sacrifice, remember the giving of themselves to try to get as many people out and away from those towers as possible. This day culminating a week where stocks were bearish and gave back some of those really mature gains we've talked about over the past couple of weeks, with volatility staying at relatively elevated levels. We're going to talk about whether or not this was the pullback, or if this was the beginning of the pullback, or if this wasn't a pullback at all. So I'm going to break that down from a technical perspective, and then we're going to talk about how to trade it with that in mind, and what can we do if it wasn't? What can we do if it was the pullback? And so we're going to take a look at that with our trade idea of the day. So let's go ahead and get started. Today is Friday, September the 11th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we have dark pink shading now, which means we have fallen below the 50th percentile, though we don't have the combination of dark pink shading and a red line. That's what constitutes an intermediate pullback. Among other things, you also have a drop below the 23% line, which we haven't gotten yet. Also, at one point in time today, in fact, again, on Fridays, if this is your cup of tea, we have our technical analysis class on Fridays. And today's class, in last week's class, I talked about what constitutes a pullback. Today's class, I talked about what constitutes a buy the dip signal. So you have 2 weeks here to contrast. Earlier today during the class, the near-term line was way down here. The momentum line was below the 5th percentile. We talked about how sensitive those are to the finish of the day. And just like that, we rallied by the end of the day to the point where neither one of them are showing bearish signs anymore. And in fact, the near-term line kind of dipping a little toe into the water, but that's about it. So, and the momentum line bouncing back up. Which goes, that was a red flag at the time. Now not so much. And so, not so bearish yet on this pattern. You can see a similar pattern, still light pink shading for that matter on the Dow Jones, and the yellow line, which is bullish. Short-term sentiment, not very bullish either. NASDAQ Composite flirted with getting below the 23% line, closed a smidgen below it, but pretty much right at the 23% line. Again, dark pink shading, but still a yellow line. We don't have the combination of the two red lines and the dark pink shading. And then the Russell 2000, same thing. Dark pink shading and the yellow line still. And again, bearish sentiment and barely dipping its toe below 40. And you can see it can do that. It can dip its toe below 40 before turning up without getting too bearish. Even over here, we dipped a little bit below that, below 40. You can see the NASDAQ just a smidgen below 40 and the S&P 500 a little bit above 40. So we'll kind of keep our eyes to see if next week we don't get kind of an immediate bounce off of this pattern based off what the market forecast is telling us. The weekly chart is showing a bearish pattern. Like, this is a bullish intermediate confirmation signal where you get a combination of a strong bullish posture and oversold momentum line with the near-term line dropping below 50. I mean, that's as bullish of a short-term pattern as you can get. So again, very good chance within the next week, maybe two, maybe into expiration and coming out of expiration, we have a little bit of a bullish bounce up into this 350 area or 3,500 area, maybe up to 3,600 before finally turning back around. That would kind of weed out all the people that think that this is actually the pullback. And it will actually sucker in some people that thinks this is the pullback. Now here we go again, right? And we know that that's most likely not the case. That we still have, even coming down to the 38% retracement would just get us to a very similar type move as this one. See, this one, when coming off of a new bullish pattern here, this is the fourth quarter 2018, we did get to the 38% on an intra-week basis before rallying off of that low point. So, that's about where we're at over the next, eventually when we do get And by the time we do get the actual intermediate pullback, we might not even that might be above the 30-week moving average might actually be above the 38% level by then. It might be we might get down to is this 78%, which is actually kind of what I'm expecting by the time all is said and done on the actual pullback. The Nasdaq, again looking at its weekly chart, very same bullish pattern right off the 23% level. Same bullish pattern here, oversold, bullish intermediate confirmation signal. And again, you can see where its 30-week moving average is. Again, if you're looking for a pullback to that 30-week after a new bullish run, we've got a long ways to go before that even happens. And the 30-week is still well above the pre-COVID high, as well as above 10,000 for that matter. So really likely we'll move down to 38% on the Nasdaq, not so much on the S&P. There's a good chance we probably stop right into this 32, 3100 eventually, but not next week, right? Next week I expect more of a bounce, short-term bounce heading into options expiration, potentially even through expiration, before eventually by the end of September into October, we'll get more of that pullback that everybody's been expecting. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us there on YouTube. That notifies you when our videos are posted, especially if you ring that bell that's right next to the subscribe button down there. Also, while you're down there, hit the thumbs up icon. That tells us two things. Number one, you like our video today. And number two, you want us to do another one on Monday. It's a quick way to give us feedback on whether you like our videos or not, and whether you want us to keep doing them or not. If you do like our videos and you want to let us know, you do it. Let us know with one click right there. You can do that right now while you're watching. If you don't like our videos, of course, you don't have to click on anything. Also, while you're down there, comment. What did you get out of the video today? What questions or comments do you have? Post all those down in the comment section below. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there, at DavidSettle42. And join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, I invite you to check out some of these other things over here on the right, including our Market Outlook live videos. Every day I do a Market Outlook. I also do a live video at 3:30 Eastern Time. I review all of my old Market Outlook trade ideas. We continue to trade them all the way up to the time I close them. And then we put on today's trade idea before the market closes. So you kind of get a little sneak peek preview of what the trade idea for the video is going to be. Again, that's what these Market Outlook Live. Just click on that icon. That takes you to that page. It's also right here on the Market Outlook Live Trade Review. Also, here's our upcoming classes. All of our Plus subscribers, our monthly subscribers, get access to all 8 of our trading rooms. Our premium subscribers here, they get access to the same thing, including the Market Outlook Live trade reviews, as well as our Q&A sessions. So I have mine coming up tomorrow morning. It's basically a free-for-all. What do you want me to talk about? I spend a couple of hours every Saturday morning with our premium subscribers going over stocks they're looking at, answering questions, reviewing different topics that they want me to spend more time on, whatever the case is. Also, while you're down here, click on this heart. It opens up this new window. Hit that like button right there. Also, click this thumbs up icon. It takes you to a Facebook page. Click that thumbs up icon right there. Those two things, again, that benefits us because the more likes and engagements these posts have, the more Twitter and Facebook will promote our content to all of our followers, even if they're not online when these get posted. It benefits you because they'll promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, now let's take a look at the 3 green arrows, and of course we have 3 red arrows. In fact, we got 3 red arrows a few days ago, but we haven't gone any lower than the low of that day, and we had a little bit of room to work with too, to that 23% level, and we kind of did filled in some of that range here today, but are not showing a bearish pattern here. So again, it's kind of like a sucker bearish pattern where it looks bearish, but it's really not, and very similar to what we saw here before we got our last leg higher going into the COVID low point. If I look at the 2-line version, sorry, let me pull that back up here. If I look at the 2-line version of this chart, you'll notice that we are below the 17-day moving average and have been now for a few days. So like, and the MACD is still pretty bearish and it's negative. The stochastics has fallen below 20. So there's a couple of red flags here in terms of, how bearish we are. And if we don't like bounce right back up here on Monday and get through that 17-day moving average, which is a red one, and potential and even more so get kind of above these highs here at 345, which I think there's a good chance. But if we don't do that like as early as Monday, as you'll see here in a second, this might be we might fall rather quickly. And this is kind of how I'm looking at it. We'll either fall really quickly on Monday or Tuesday through the 23% line in kind of one fell swoop, most likely driven by some kind of catalyst over the weekend that the market obviously was not expecting, otherwise we'd already be dropping there. Or if we don't get that catalyst, more than likely from a purely technical perspective, we bounce right back up here over the next few days, get back above 345, and then we'll most likely continue through that, like I said, September expiration, potentially on past that after that. If you take a look at some of these other oscillators, they kind of confirm that. You look at the RSI, it's below 50, but it's not below 40. The CCI below a negative 100, but not below negative 200. So those look bearish, but they're actually kind of bullish by the dip signals. You also see it too on the DMI. The DMI, the positive index is below 20, but the negative index is not above 30. So it looks bearish, but it's actually more of a buy the dip signal there. And then you look at the Ichimoku cloud, and we are below the blue line. We're above the cloud. The red line over here is above the price. That looks bearish, but it's actually a buy the dip signal. Now again, I don't think it's a buy the dip signal to the tune of like this move where we had a couple of months of really good returns, because that was kind of the last time we had a bearish looking buy the dip signal over here. This low point right here, the red line is right there. So we had that move to keep us going up and stay above the price. So we had a pretty decent move there. I think we'll get a very similar move, like I said, over the next week or two before we finally break down, after September, I believe after September expiration. Let's take one more look at the Bollinger Bands here, and you can see, we're back above after a couple of days here. Instead of staying below, which is what happens when you are in a bearish intermediate pullback, you stay below the 25th percentile, if not go below zero. We're not getting that here. Every time we get below the 25th percentile, the bandwidth, we come right back up above it. So we'll see if that plays out, especially with this, the top of this value area holding for support. That's, like I said, I think we can get up and towards this 350 by post September expiration, get up towards 350, if not closer to 360 by the time all is said and done. One more chart I wanted to look at here on the long-term chart. Again, look at that bearish candlestick pattern. So we've got this before, and then we had that last leg higher. This is the kind of thing I'm expecting, this type of pattern. Or, like I said, or Monday or Tuesday, things get really, like we drop through the 23% level very quickly, get a pretty decent sized jump in volatility, and now we have our intermediate pullback. And I think that's the lowest likely outcome. I think this is the more likely outcome, where we bounce up maybe another week or two, maybe three, before we finally get more of the decline. Again, not that big of a decline, not this, more like this, something like this, where I don't even think we get to the 200-day moving average. We might, because you can see now that the 40-week moving average is flirting with the 78% level. We might come down to it by the time it gets there, maybe a little bit below it, but then that's it, right? I don't see a death cross coming anytime soon, but we just basically got out of one. All right, now let's take a look at the intraday chart and go a little bit more shorter term, and you can see, you can see the new low. In fact, we have a low on the right and a high on the left. That's more of a bearish. Usually bullish, you have your low over here and your high over here, and that's not the case right now. In fact, again, there's where our 350 level is. I mean, if we bounce up towards expiration back up to the 350, and you have to clear a pretty decent support level to do that. That's why I said that 345 is important for multiple reasons. One of them being that you've cleared this 338 support. Otherwise, with that hanging on top of us, we drop pretty sharply. But again, we'll probably need a catalyst over the weekend for that to happen, whether it's COVID related or election related or whatever. Some kind of catalyst the market hasn't been expecting would need to cause that for that to happen. If you take a look at today's volume, it is above average again, 84 million, but the range wasn't very big. In fact, the range was just not very big. That's in context, right? Just barely above the average, but still at 6 points. So when you look at the volume here and the range, it's peaking. The ATR is getting to a pretty decently high level. We talked about before when it got to the 1% that we'll probably bounce up towards the 2%, but that's probably where we're going to find some resistance. I don't think, like, we'll probably get a few bigger days and then kind of grind. I don't think we'll get all the way back down before the intermediate pullback really begins. The other thing too that suggests that this is a buy the dip is the volatility didn't spike up to 100, 105%, which is typical of intermediate pullbacks, especially right at the very beginning of one. And then just like that, we're back down to the sweet spot of bullish territory. That's a bullish volatility index right there at 85%. As bearish as it may seem on the chart itself, this is a pretty bullish for stocks, not bullish for volatility, but bullish for risk appetite to see the volatility index right in that sweet spot. So another sign that this is more of a buy the dip type signal here this week, more so than a, oh no, here we go, this is the pullback signal. And definitely not a, this was the pullback and now we're done and here we go for another 5 months to the upside. And that's hardly the case. So to summarize, we've had a pretty bearish week, obviously, more bearish than we've had in a long, long time. Was it bearish enough to constitute a quote-unquote pullback? Was it bearish enough to even be the beginnings of one? Or is there an opportunity for us to bounce right off of this? So I believe it's the latter. I believe that there's a lot of buy the dip signals as I showed you off of these different indicators. Whether or not we'll get a month or two out of it, I highly doubt. I think more likely we'll bounce into September expiration, potentially through expiration, before we finally actually get the real pullback. And as I tell market scholars all the time in our classes, intermediate pullbacks, and most of the damage during intermediate pullbacks are done before you know it. So if this isn't kind of if we bounce off of this, this was your warning, right? This was your warning to be able to clear some risk if you haven't already, and so you're not caught too one-sided when the real pullback occurs. Because again, by the time the intermediate pullback has done most of its damage, there's nothing you can do about it. It will be down. Like I said, if this is the beginning, then that means we'll fall hard Monday or Tuesday again before you can do anything about it. So at least if you haven't already, as we keep saying over the past few weeks, maybe a month or two, of de-risking, of lowering deltas, not to zero, but lowering your positive delta so you're not so bullish. So when a week like this week happens, it's not that big of a deal. In fact, we're actually up this week in our class portfolio, so it's not that big of a deal because we're not nearly bullish. We're not so bullish. We're not so one-sided in the markets right now. So what do you think? Do you agree with that assessment? Do you disagree? Let me know down in the comment section below what you're thinking there, especially if you disagree. I'd like to keep the conversation going there. Show us what's driving your opinions on why you're a lot more bullish than I am or you're a lot more bearish than I am. All right, now let's take a look at what's driving this price action. And you can see that this week was a risk-off week. I mean, look at Q's down more than 5% at one point, down 4.5% by the time it's done. The S&P down as well. If you notice, international stocks weren't so bearish. In fact, developed market stocks actually finished the week strong. Not strong, but positive. Emerging market stocks outperformed U.S. equities as well. You can see global bonds doing well, of course. Even with the dollar, gold is up. So the dollar and gold and bonds are all up this week. Kind of shows you the risk-off nature. Commodities were down, but not down as much as stocks, and that's rare. Commodities are typically a lot higher beta than equities are, but of course, QQQ being the biggest mover right now in either direction, falling down. But a lot of times you see crude oil, especially, falling down quite a bit, and you can see small cap stocks outperform for most of the week the S&P before giving back some of those relative gains, just small relative gains, and finishing. So I mean, it's a pretty broad selling in the U.S. but not globally, and especially not in other developed markets overseas. Europe, especially. In fact, if you take a look at here, let's go to back to this chart here, and let's take a look at the global stocks here, the 12 grid for all the biggest economies in the world, and you can see, dark pink shading in the yellow line in China and Canada, and Russia's got the red line, and Brazil getting the red line, UK a little bit too, but look at France and India, look at Italy, look at Germany, look at Japan, all still holding up very well with dark green shading and green line. So that's where, and South Korea as well over here, that's where the gains continue to be kind of from an international. That's a different theme than what we've seen over the last few years. It's usually dark green shading and pink lines over and green lines over here, and dark pink with red lines everywhere else. That's not the case right now. The script is flipping here a little bit. I do expect us to get back to where these are too. So we'll get back to dark green shading. We'll get back to green line on the S&P, but not, only temporarily before things turn back around. We get, like I said, the real pullback where you get the dark pink shading and a red line. Like right now, you're actually seeing here in the UK and Russia, and to a bigger degree in Brazil. This is the type of bounce I expect us to see in the U.S. just coming from the 30-day moving average instead of so far below it, like we see here in Brazil. Of course, the biggest reason for that pattern is what's going on with the dollar. And so here's your euro U.S. dollar currency pair. Look at that long upper shadow here, and the pink shading we're getting here, and we actually did get a red line temporarily, turning back green. But I expect a little bit of a decline in this. We've had a good run. I don't think the long-term run is over. On this pair, I think there's an opportunity for us to be, a lot more bullish for a while. But I do think we are in the process of a near-term decline on the euro-U.S. dollar. So bullishness on the dollar will equate to a little bit of a pullback in risk appetite as a whole. So that's a big driver. I also saw mention too on the TD8 Ameritrade network actually about a falling dollar typically leads to falling yields. Well, that's true in some cases. Right now, that's not necessarily the case because yields are already pretty low, and yields might drop. If we do get an intermediate pullback, you might get a little bit of a decline here. But this is also an inflationary. And with the falling dollar being inflationary, that typically leads to rising yields. And you can see here over the last little bit, inflation expectations, it's really since July 22nd, have really taken off here. So if I look at the 10-year yield on the daily chart, go to the market forecast indicator here and look at the 10-year yield. You can see again, we have July 22nd in here, a little bit of a fall, but then after that, look at the rally we've had as inflation expectations got back to a strong higher level in this area. Breaking through this 170 by August, getting up to really strong levels, and so that is associated with rising yields. That will reflect rising inflation expectations. And you have a bullish market forecast chart with a bullish intermediate confirmation signal. So I would actually expect yields to continue to go higher. All right, so now let's take a look at the sectors and how they perform this week. And interestingly enough, energy continues to be the biggest weak performer, even though the tech sector was the biggest loser from a QQQ standpoint, as well as and commodities didn't fall as much, but energy really struggling. And then you can see technology and communication services pulling back more, which is not surprising. They've been the biggest winners. They had the most mature trend, and they've now dropped more. But up here at the top, look at materials had a positive week here. Discretionary was positive for most of the week and finished outperforming. In fact, it was one of the only cyclical areas way outperformed XLC and XLK. And then you can see all the utilities, staples, real estate all outperforming the broad market as well. A little bit of a risk-off standpoint, all down, but all outperforming. with XLK down about that same 4.5% or so that QQQ was down. So, we saw a little bit of a rotation. Again, this is the warning sign. Now, I expect that those will bounce back up more over the next week or two. But that's not a reason to get more bullish in those. It's your warning that if you already are still too bullish in those, as we rally, to take some off the table, take advantage and take some off the table, so that, like I said, when we get the actual pullback and they have the most to lose because they don't have as much margin of safety as some of these other cyclical areas like industrials or materials, then you won't get hit so hard because you won't have such a big exposure to them. So you're getting a benefit here, in my opinion, a little warning shot of a decline that looks like a pullback and will offer you a bounce. And now the question is, are you going to take advantage of that bounce, or are you going to get suckered into that bounce by getting even more bullish than we should be? That's how, that's what remains to be seen over the next week or two. So for our trade idea of the day, I wanted to go into the financial sector and take a look at a stock that, like the market as a whole, is showing us, like, it looks like it's bearish, but it's giving us more of a buy the dip type signal, and that's Morgan Stanley. It's got some bearish short-term sentiment. The intermediate line's down, dark pink shading, but only a yellow line, and not below 40 yet on the intermediate line. If I take a look at its weekly chart, buy the dip signal here. Strong bullish posture, oversold momentum line, near-term line down below 50. If I take a look at some of these other oscillators on Morgan Stanley, we're below 50 but not below 40, below negative 100 but not below negative 200. Look at the DMI here, and you'll see that we are below 20, or flirting with getting below 20 on the positive, definitely not above 30 on the negative. So it looks more bearish, but it's more of a buy the dip type signal. You look at its Ichimoku cloud pattern, we are below the blue line but still above the cloud, and the red line still above the price, and that's kind of the move for us to stay, for the red line to stay above the price. That's the kind of move that it would need to get here in the short term, which means that we might get a pretty decent opportunity for a bullish trade in the short term. And so what I want to look at here is selling a short put vertical spread and trying to get 50% of the max gain as quickly as we can in the next week or two on any short-term bounce that we get. Otherwise, if we do get a short-term bounce and then pull back, we have some room for it to go up, move this back, and then we can come down, and depending upon where we're at, still be able to get our gains. So in the next little bit, if we were to bounce up here, again, selling the 48 put, buying the 46 put, we get for a full position because we don't have to worry about earnings quite yet, and then we'll get a good 30%, at least a little bit more than 30% return on risk. So a high probability trade. You can see where the break even is. If you take a look at the Bollinger Bands, that break even happens to be below this very strong point of control. So we have very strong support that can keep us afloat if we were to bounce up and then pull back. Very strong support that can hold us up above that break even level. Alright, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums on marketscholars.com. You can open up any new thread there, reply to anybody else's thread, and let's keep this conversation going with the things that we talked about here tonight. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, as well as that like button on Twitter and on Facebook, and then comment on our video down below. Join our website at Market Scholars. Follow me on Twitter, as well as our Facebook group. Have a great rest of your weekend, everybody, and we'll see you all next time.